Welcome back, guys. So for now, we are going to investment center evaluation. Now, reminding you, when it comes to investment center evaluation, we have an additional challenge. Unlike profit centers where we only have to be concerned about whether the revenues exceeded the costs and thus earning a profit, in investment centers, this is not enough. Why? The manager of an investment center is also accountable for the effective utilization of the assets. To give you a hypothetical example, let us say that you are controlling an asset base of 1 million pesos. Earning 100,000 a year may seem good. However, earning 100,000 a year for a 1 billion peso asset base doesn't seem quite a good performance. So when it comes to investment centers, we're going to have an alternative performance evaluation measure. This is, first, the ROI. The ROI, that is return on investment, is the income or loss generated relative to the amount of investment. That is, when there is 1 peso of investment, you would make an investment of 1 peso. How much centavos would go to profits as a result of having such an investment? If you invest 1 peso, how much in centavos would go to profits? To illustrate this measure, let's go to the following case. KNC Department of MBN Incorporated has shown the following assets for the year ended 31 December 2018 and 2019. That is, in 2019, 2 million. In 2018, that's 2.8 million. Income statement for the period ended 31 December 2019 is also given. Now, let us calculate the ROI. ROI can be calculated this way. That is, you will take your amount of income generated in the period and divide it by the amount of assets invested. You have the ROI formula. But remember that income is an income statement account, and therefore, it already pertains to the entire period. While assets is a balance sheet account. As a balance sheet account, it only pertains to the end of the period. So, income statements pertain to the entire period, say of year 1, starting January 1 of year 1 to December 31. While balance sheet accounts, they only pertain to the last day of the period. That is why, when it comes to balance sheet accounts, we're going to put them together with income statement accounts. We have to take the average between beginning and end. So for this problem, we are going to divide income over investment. What would be the relevant income amount? We're going to use operating income. That is operating income, and divide it by the amount of average assets. Why operating income? Well, when it comes to operating your assets, this is the amount generated. Interest expense, which is not deducted in arriving at operating income, is more like the share that the debt holders will receive. As a result, they should be excluded. Treat them as if they are dividends to be paid to the debt holders, not technically expenses relating to operating our investment center. Now, you have here 600,000 operating income, and divide this by the average of the beginning and ending assets. The average of 2 million and 2.8 million would be 2.4 million. 600,000 divided by 2.4 million, we would have an ROI of 25%. This is the ROI for our segment. So the ROI is a very good formula when it comes to looking at the size of your profits relative to the size of your investment. Rather than simply looking at whether there's a profit, we should make sure that that profit amount is commensurate to the size of the investment. Does it justify the size of the investment? Aside from the ROI calculation as it is stated here, we have an alternative way in arriving at the ROI. That is the DuPont equation. The DuPont equation states that ROI is equal to your asset turnover multiplied by the profit margin. Actually, this would at the end mean the same, as ROI is equal to asset turnover times profit margin, as asset turnover is equal to sales revenue divided by investment, and profit margin is equal to income divided by sales revenue. You would basically have the same equation if you're going to look at the original formula. Just cancel out the sales revenue figures. We will have an alternative calculation of the ROI, that is the DuPont equation. Now, here's another sample case. CMN Incorporated is a subsidiary of Universal Corporation, has shown the following information. Asset turnover is 5 times, profit margin is 2%. Using the DuPont equation, we can calculate ROI this way. ROI, this is equal to your asset turnover times the profit margin. You have here 5 times 2%. ROI is 10%. So what's the point of this calculation? Why would we want an alternative way of presenting our ROI calculation? Well, it has something to do with how to communicate to your top management as well as to non-accounting and non-finance people in the company on how to increase the ROI. If we follow the DuPont equation, we may increase ROI by doing any or both of the following. Increase your asset turnover and or increase your profit margin. What does it mean? When you increase your asset turnover, you're basically making good use of your assets. Sales can be an indicator of utilization. The more you sell, the more you use your assets. A factory producing goods would be considered well utilized if it produces more goods. If it will produce more goods, it can generate more sales. Hence, sales can be used as a representative of utilization. The more sales generated for a given amount of assets, then it follows that you are utilizing your assets well. That is one way to increase your ROI. However, that would mean nothing if you are going to have no profits from every sale. That's why we have the second component, increasing the profit margin. When we increase the profit margin, we basically say that for every peso sales, there should be a large centavos of profits. In this way, every time you use your assets, that is, you sell them, there are profits that come in. A combination of these two would lead to a higher ROI. Thus, if you are going to communicate with a non-accountant or a non-finance professional, it would be useful to use the DuPont equation to explain what it means to calculate your ROI and why is it a good thing. Now, it is, however, the case that ROI can cause sub-optimization. There are cases where ROI will lead to incongruence of goals and hence would lead to sub-optimization. Let us go to this sample case for an illustration. Let us say you are a manager of one product division, a segment of Justin Corporation, with an average invested capital of around 2 million. You boast one product division's ROI of 20%, which is higher than Justin's required rate of return of only 12%. It is in the belief of the top executives in Justin Corporation that any investment that gives the company a return of 12% is desirable. and thus should be engaged in. Justine evaluates its subordinate managers on the basis of ROI. A new project requiring an investment of 500,000 is available and can give one product an additional ROI of 15%. That is, it gives an additional income of 75,000, which is 15% of 500,000. Going to the sample case, according to the top management, a subordinate level manager should only aim to have an ROI of 12% and above. Thus, from the point of view of the top management, every other investment that would earn not less than 12% would be considered a good investment. However, the subordinate level of management is evaluated on the basis of ROI. That is, the higher the ROI, the better. As the department manager of one products, which is a department of this company, you would strive to increase your ROI. Let me demonstrate to you, this could possibly lead to incongruence of goals. Now, remember the top management simply wants an ROI of not less than 12%. But as the manager of one products department, you would want to increase your ROI because that is your basis of evaluation. Let us look at the ROI before taking the project and after taking the project. Before taking the project, you're going to have an ROI of 20%. We're going to assume that if you do nothing else, you're going to have 20%. Working back on the given, we can extrapolate that our income must be 400K. Why? The investment is 2 million and hence our net income must be 400,000. If you're not going to do anything new, just do it the same way, you're going to have an ROI of 20%. What if you're going to take the new project? As far as top management is concerned, this is earning 15%. It passes the 12% test. It would be top management's desire to have this project within the company. However, let us look at the impact of this project to our division. If we're going to start with 400K and this project will give an additional income of 75K, we're going to have 475,000 of profits. But the amount of investment is now 2 million plus the investment of new project, which is 500,000. 2.5 million. 475K divided by 2.5 million, this would give you around 19%. Thus, as the manager of one products, the division of this company, you are hesitant in taking this project. You are not encouraged. You do not believe that it will be for your benefit that you are going to take this project. So this is the problem of ROI. There is a tendency for sub-optimization. That is, the top manager would simply focus on his or her part and ignore the overall impact on other parts of the company or even the entire organization. Maybe it would be better if we're going to have another type of performance evaluation. We have it here, the residual income. The residual income is the amount of income generated in excess of the minimum income for the investment. That is, RI is equal to income minus minimum income, and your minimum income would be dependent on the size of the investment. That is, RI is equal to income minus assets times the minimum rate of return. Residual income is an absolute value rather than a ratio. Let us have one sample case in calculating the residual income. Standard Corporation, a subsidiary of Martoni Holdings, has shown the following info for 2019 and 2018. Income for 2019 is 120K, 2018 200K, assets 700K in 2019 and 800K in 2018. The imputed interest rate is 12%. Now, let us calculate the residual income for 2019. Residual income for 2019, you have the income in 2019, 120,000. We are now going to deduct the minimum income for this investment to be considered a good project. We should base it on the size of the assets. Again, balance sheet accounts, this should be average, beginning and end, so that it would be consistent with the period of operations. 700K plus 800K divided by 2 is 750,000. Accordingly, this should at least earn 12%. 750,000 times 12%. That's your minimum income. So you would have here 120K minus 90,000. 120K minus 90K will give you 30,000. This is your residual income. Notice that the income generated of 120K is higher than the minimum of 90K. And thus, we can say this is a good investment center. The investment center is operating well. Well, actually, as long as your investment center will not have a zero residual income, or zero is sometimes acceptable. So as long as the investment center will not give you a negative residual income, then you are actually having a good performance. Unlike ROI, residual income again is an absolute amount. It is not a percentage. There will be added challenges for this later on. But for now, we are going to look at residual income as a potential alternative for ROI in certain circumstances. In the next video, we are going to explore the benefits of using residual income rather than ROI when it comes to facilitating everyone to attain goal congruence. That is, to keep the goals of each segment consistent with those goals of the top management. Okay? So stay tuned. Like, share, and subscribe.